Good rainy day.
Mm-hmm. The warm days will be here soon.
They will, and everything's turning green, and there's robins.
Yeah, birds were chirping this morning like crazy, so we'll give it that.
Like somebody posted on Facebook the other day and said, "Is outside broken? The birds won't stop chirping."
No, they're just getting sick of the dreariness as well.
Yeah.
But happy Friday all the same.
I'm Ruth Sheehan.
And I'm Danielle Tully.
And we're putting the real in real estate. Today we're talking about
PMI.
WTH is PMI.
PMI, that is private mortgage insurance. That's easy to say, huh?
That's why we say PMI.
Yeah, right. Right, absolutely.
If you think our industry is full of acronyms, the mortgage industry has them to the nth degree.
I think that's part of the reason we seem to have so many is because we have to deal with lending and lenders, and everything is acronyms.
Is it VA or FHA? Is it? Oh, we should do those too.
Yeah, I was actually going to have next week. So tune in next week to know what VA and FHA is.
All right. But PMI is private mortgage insurance, and that is insurance for your bank, not for you. Like most insurance, like your regular homeowner's insurance is pretty much insurance for your bank.
Absolutely. So it's the insurance. So the insurance for that is required by the bank that you prepay when you're going to close. That is for the actual property itself to be insured. This is to protect the banks in the case that you stop paying.
By the way, if any of our favorite lenders are tuning in, and you've got an answer for me, Danielle, in our pregame show, we're chatting about where was PMI in 2008? Why were there so many defaults when presumably, and I know that some people didn't have it, and I know that there were extra ways that you could pay it down or get a second mortgage to cover it or all of that stuff. So notwithstanding that, where was it on all of the other mortgages that it should have been? Presumably, that's what it's there to stop. I mean, maybe not, but
anyway,
answer that question, please.
So regardless of what happens to the banks, you don't have a choice if you are putting down less than 20% of the loan to value. So we've talked many times about the benefits of being able to buy home faster than you think. You don't need the 20% down. There are conventional loans that go for 3 to 5% down. FHA loans are 3.5.
And FHA loans, by the way, have their own form of insurance on the mortgage.
Correct.
So it's a little bit different. So that doesn't come into here. And also, you don't have a choice that something needs to be done, but there are some choices we won't go into because they're very much lender based. But there are some options for prepaying or paying it a little bit differently. Mm-hmm. That is possible. But for most people, it's just an additional amount that's going to go on your mortgage every month.
So it is a percentage based on, so it can run anywhere to like 0.5% to 1.5% or so, depending again on how much you initially put down. The cost, as you can imagine, if you're insuring, if a mortgage company wants to be insured that they're going to cover their risk, they're going to require more if it's only a few percentage points down, like a couple $1,000s, opposed to 10% or 15%.
Yeah, and it's also based on that 80-20 LTV. There's another acronym, which means loan to value. And that means if you have a $100,000 house and you owe $80,000, you're at 80% LTV. That's where PMI would. Yes, Madison. I was just saying that. Good call. So when you hit that 80-20 break, you are eligible to have the PMI removed. However, there's two ways to get there. One is appreciation of the value of your home, and the other is paying it down. Right? So if you're using that $100,000 house, and of course we don't have any of those, but I can do the math, and you put 10% down, well, you have $10,000 to pay down to get to that 80%. But if your home appreciates to $110,000, now you have hit that
20.
mark.
Because you have $90,000 loan, 110% value. So that is where the 20.
So the percentage might be what, 112
is
or
more
something.
like
It goes up a little bit. Yeah. But
2, something like that.
so I can't really do the math even on 100,000. But the bank is never going to check with you to see if the value of your house went up.
Correct.
So that's on you. So if you are a person who got a mortgage, oh, awesome. Tell your mom I said hi, Madison. So if you're a person who got a mortgage a year or two ago with less than 20% down and you're paying PMI, and home prices, we know in most places went up 20% this past year. Guess what that equals? So you need to find out from your lender how to get rid of PMI and go through the process. They will not encourage you most of the time. I mean, especially your bank, your servicer.
And we'll help you. I mean, reach out to us and we can give you, especially if we've recently had, but even if it's been a while, give us a call and let us know that, hey, you know what, you got this PMI and you're thinking you might be close.
And we can help you figure out the value of your house.
Absolutely.
And whether it's worth it to try to get that removed right now.
Absolutely. Yes. So, but Ruth and I had this discussion beforehand, though, on if it should be avoided.
Madison, that would be, they would typically do an appraisal, which would be a third party. That's not always going to be the case. If they think it's a slam dunk, they might just go ahead and remove it. But if they think there's a question, then yes, there would be an appraisal. And I'm assuming, Danielle, that you would pay for the homeowner would pay for that appraisal. So,
but it should be worth it because again,
yes.
At the half a point to almost 2%, depending on what it was. I mean, that's $30 to $70 a month per $100,000. So if you have a $300,000 loan for $200, a month almost, possibly, you could be saving. So it might be an appraisal for $500-$600. Well, in 3 months, 4 months, you'll have saved that.
Yeah.
So yeah, definitely something to look forward to. But Ruth and I were talking beforehand if this is something that is necessary. So not necessarily necessary to avoid. So we were talking about, of course, if you're there, get rid of it. But, another thing that is I was saying is helpful is that if you do have this now, but your home is appreciated and you're looking to buy or sell, that could be a savings. If you put that loan, your equity into the next home, you could be.
And then don't pay it on your second one because you can roll all of that profit into it if you'd like to, or as much as you need to. Now, I personally do not mind PMI. I have paid it on just about every loan we've ever had, every mortgage. Because to me, I would rather hold on to my cash and do something else with it than put a large amount down on my house. And when you're in an environment where your house is likely to appreciate quickly, then you can do both. You can hold on to your cash and you can get rid of PMI in a short amount of time. But it really comes down to comfort. So our assistant, Tammy, and from our conversation, Danielle, similar, I cannot stand having a car payment. For lots of people, a car payment is just one of those monthly bills. It's just something that they work into their budget. It drives me crazy to finance a car, but I'm fine with PMI. Tammy will never have PMI on any house she ever owns, but she's cool with car payments. So the thing about it is calculable. And you can decide based on today's mortgage rates, are you happier with your money in your house or elsewhere? I'd like to, get a new bathroom or something with that money, and it's still in my house, but I have a new bathroom. So,
well, that's reinvesting into the home too. But
right.
I mean, and I'm not saying that equity needs to go into that, because it is okay if you're talking about, like I said, 0.5%, maybe up to 2% monthly for X amount of years, opposed to, what would you pay if you had to finance, even a home equity loan is going to be higher than that.
Right.
To make these changes into a new house, or if you have some other debts that are 17% or 10% or whatever. I mean, obviously
so it's just something to consider. It's not the end of the world if you put down less than 20% and you pay the PMI. But you want to know what it is, what you're paying, and what you're getting for it. So
right. So it is. So we just want, because again, we talk about, the positives of, being able to afford buying a house with not needing 20%. But we also wanted to give you the flip side of, there are some other things that, play into the part. But again, if it comes down to it and you're comfortable, and it is something that your lender is going to provide to you as part of your monthly payment from the beginning, you're going to know that all plays a portion of it. Then, it's okay.
And this is another place where what you pay for your house doesn't matter. I mean, what the price of your house is doesn't matter until you sell it. It's the monthly payment. So this is one of the things that goes into that monthly payment. And it might be, if you're, close to your budget, it might be the difference between going out to dinner once a month or not. So it can affect your lifestyle. And you just want to look closely at it and don't just assume automatically that one way to go is better than the other.
So now you know a little bit more what PMI is. Also, that it is not hard to get rid of it. So if you think you might be close, or you definitely, just want to see if you can get rid of it, give us a call, because we are happy to help.
Absolutely. And Madison, nice to see you.
So, yes.
Take it easy. We'll see you next week with FHA and VA.